So you all won't stop tagging me in this video, so let's go ahead and take a look at it and see what they have to say, and I'll give you my thoughts on it.
Stop putting everything in your name, create a business, an LLC, put everything in your LLC. And open up a C Corp, and if you don't know this, you need to figure these out. I'm telling you the names. Get a C Corp to run an LLC. If you want to make it even deeper, go get a trust fund and run a corp that runs the LLC. You want to get even deeper, own 2 trust funds for your business and your person to run that trust that runs all the business. It can get deep, my God.
Absolutely.
And Donald Trump actually showed me that method. That's how he didn't pay tax.
So this is my business trust.
What a way to start off your video with the great intellect of our time, Waka Flocka Flame. Just to kind of breeze past Waka's part of this video and get to the main part that most people are asking questions on, which is probably this gentleman's portion of the video. Waka gives no substantive reason for any of the things that he says. There's no reason for him to set up these entities, or at least he gives no reason to do so. By nature of setting up multiple entities, you will not just simply reduce your taxes. Sure, there might be some timing differences if you have a C corporation rather than all pass-through entities, and if you have certain high levels of taxes, maybe that C corporation tax might be more beneficial, keeping in retained earnings. But understand that it is a very small set of circumstances that you might benefit from having various entities. Having a number of trusts, having a number of C corporation, number of LLCs, owning everything in LLC doesn't change the fact that you still have personal things and you still have business things, and those things need to be separated in terms of what is deductible and what's not deductible. So nothing Waka says there is of any benefit to anyone. So please understand that. So let's get to this gentleman's video talking about multiple entities, I guess.
And then I have another trust, which is my family trust here. And this family trust basically does everything, okay? The business trust is a member of my LLC where I'm a member. This is me, Brandon. I'm a 5% member in my LLC, whereas my business trust owns 95% of the LLC. So why do I set it up that way? Well, because my business is profitable, right? Me, Brandon Clark, the person, is responsible for 5% of the taxes that this business makes as an individual person.
Sure, but let's figure out who the beneficiaries are of this trust, because if you're not paying the taxes, then the trust is paying the taxes, which is silly.
Whereas the business is 95% responsible for those taxes. So if we put numbers to it,
I guess.
If I had $100,000 of income that would be taxed, then I would be responsible for $5,000, and I would have to pay taxes on that. Whereas the trust would have to pay taxes on $95,000.
Full stop. That is correct.
Responsible, right? And so my CPA is looking at this right now and say, man, why would you have a structure inside of a trust? Because trusts pay higher taxes than everybody. Trusts pay about 37%.
Trusts pay the 37%, which is the top marginal tax rate, much more quickly than individuals do. This is how you know that he's not a tax professional giving you advice on taxes. So just starting off not great. But at about $15,000 of adjusted gross income, you'll reach the 37% top marginal tax bracket inside of a trust. That's what he's talking about.
Taxes, right? And so that's where the strategy comes in, because what you could do from this point is you could actually transfer or donate the full $95,000 to the beneficiary of this trust.
You do not donate your money to the beneficiary. The beneficiaries have the income passed on to them if the trust decides to distribute that net income to the beneficiaries of the trust. If the trust is not going to pay the tax, it passes it to the beneficiaries via a K-1, and the beneficiaries pay tax at their individual rates. It is not donated to the beneficiaries. That is not how that works. Donations are to nonprofit organizations, 501c3s.
To make a long story short, this $95,000, I would owe 36 to 37% of taxes on that amount. But because trusts are these special entities, they can do something that we as people can't do. They can do things that S corps can't do, C corps can't do, LLCs can't even do this. Trusts have the ability, the unique ability, to transfer or donate 100% of their gross profits, gross revenue.
That is true. You can have something called distributable net income in a trust that reduces the trust's taxable income to $0 because it distributes that net income to the beneficiaries. Sure. Or it can donate to a nonprofit, something that actually can accept donations. You can take a donation deduction for up to 100% of its adjusted gross income. That is true.
So I essentially could take this $95,000 and donate it to my...
No, you essentially cannot. You can take a distributable net income deduction on your trust tax return and transfer that via a K-1 to the beneficiaries.
Family trust. Bam. So now I got 95 grand in my family trust, and we got our trustee, and then we have the beneficiary. And I kind of skipped ahead of myself. The beneficiary of my business trust is the family trust.
So yes, it would just be a distributable net income deduction on the trust, and then that $95,000 just goes on a K-1 into that other trust. So what we just did is we took it from the LLC, took a little pit stop inside of a trust for no reason, and then we went to another trust. So nothing has happened in between these things. You did not donate that money to another trust that you own. That did not just happen. What you did is you just transferred $95,000 of taxable income from the LLC into a trust into another trust. We still have $95,000 of taxable income that still needs to be taxed by someone or something, either the trust or the beneficiaries.
So now I get to pass that in for that entity, or not that entity, pass that income through all of my entities without paying taxes.
Well, I mean, yeah, he hasn't paid taxes yet, but he will pay taxes. Someone will pay taxes.
And I can basically spend that money on the beneficiaries, which are my kids. And so this is the protection piece here. And so the trust can own things like automobiles, it can own property, it can literally own anything that you wanted to own. And so what I have is 5 insurance policies, and I could actually use the money that I receive or income that I receive into the trust, and I could use it to fund these policies.
That's fine. Your family trust can have those policies. Your family trust can own those assets, your automobiles, your house, whatever it might be. But understand, none of those things are a deduction against the $95,000 of taxable income that is inside that trust. So if you have the trust pay for all of these things, they're personal and they're not deductible, even in a trust. So what you're going to have is $95,000 of taxable income that needs to be either taxed at the trust level or the beneficiary level.
All right. And is there some questions in there? I saw like a question. I'm going to answer like 2 more questions and then I got to head out. Yep. You don't pay any taxes. Hold on, wait. Is the money that's passed on from your life insurance policy subject to tax or not? What is the purpose of putting into the trust? So 2 purposes. The trust is protection. It's really protection from the taxes and then protection.
Trusts do not protect you from taxes because trusts are not tax shelters. A tax shelter is just simply something that reduces or defers income taxes in some kind of way. Trusts don't do that. Trusts are taxed entities. They either pay tax or the beneficiaries pay tax. So that is wrong. And anyone who tells you otherwise is lying to you or doesn't understand trusts. So just understand that. Now, they do provide some legal protection for you.
Lawsuits and stuff.
Which is fine. I'm not an attorney. I'm not going to talk about those benefits, and you should talk to an attorney about those if you are curious. But they are great for estate planning and controlling assets either beyond your death or for those that you don't believe can manage their own assets very well, right? They need someone to kind of be in charge of those things for them. Those are great uses for trusts, but they are not tax shelters. All right, so he's going to get into a whole bunch of stuff that really doesn't matter. So here's what we're going to do. We're just going to break this down really quick for you. So what we had is we had an LLC that made $100,000. He has a K-1 from that LLC of 5% or $5,000 that goes to his personal tax return. He's got a K-1 in his personal name, $5,000 on his personal tax return. He then has $95,000 that's passed through on a K-1 into his business trust, his first trust. So that business trust, he then donates. Now, he has a distributable net income deduction of $95,000 on the trust. So the trust doesn't pay any taxes, and it goes to the beneficiaries. And the beneficiary on that trust is another trust. Okay? So what we have is $95,000 that's gone in a K-1 from the, partnership at the top into the business trust, and then it's going to have a business trust K-1 that goes down to the family trust. So the family trust has $95,000 of taxable business income in it. So then that family trust is going to have actual beneficiaries that aren't just another trust. And so the trust has basically 2 options on what it can do with this money. The first option is this. The trust can pay taxes at the trust level, which is going to be quickly 37%, and then it can distribute the money out of corpus into any of the beneficiaries. That's fine, and they won't pay any taxes on it because it's already been taxed. Or number 2, it can have a distributable net income deduction of the $95,000 and distribute it to the beneficiaries in the way the trustee deems appropriate. That's more than likely what's going to happen, right? Because he even says he doesn't want to be taxed at the trust rates. So let's say he puts $80,000 to him, and then he has like 3 kids, so $5,000 to each one of his children. If he were to do that, understand that means he's going to get a K1 personally of $80,000 goes on his personal tax return. So now he went from $5,000 K1 from the partnership into another K1 of $80,000. So he has $85,000 over here. And then his kids are going to get the remaining $15,000. Now, the kids are not active participants in this business, my guess. And so this business income will be passive business income. And what happens when children, dependents, receive passive income? They can be subject to something called kiddie tax, which means they will owe taxes at the same rate as their parents on their passive income once they have more than $2,500 of passive income. So any benefit that you are looking to have by separating out the income in this way through these various trusts onto these different beneficiaries is pretty much mitigated by the tax code and the fact that trusts are not tax shelters. So yeah, this is not an entity structure that is going to reduce all of your taxes. If it was, I would be screaming it from the rooftops. And understand, this is not me coming from a place of trying to find ways that this won't work. I've looked many times into these various trust schemes that a lot of people talk about on social media because I would love it if there was any merit to them. That'd be fantastic. There just isn't, because that's just not how trusts work. I wish they did, but they don't. Thanks so much for watching. Be sure to like, subscribe, comment, and hit that notification bell. And if you see any videos across TikTok or Instagram, be sure to let me know. Again, thanks so much for watching. I'll see you on the next video.